Welcome to another infographic instant with Brian Michael. In this episode, we'll be looking at which countries and emerging markets are likely to lead the trade credit and investment insurance boom. We've been talking in this series of infographics about the various segments of shadow banking. Until now, we've ignored trade credit and investment insurance, two areas that generate cash and that generate potential lending assets, and which in their own right attract significant amounts of resources for aspiring asset managers. Now, turning our attention to the infographic, we can almost see two groups of countries. Looking first at the trade credit numbers, medium and long-term trade, we see a group of countries which have high trade volumes in absolute terms, looking at Russia, India, Turkey, Brazil, keeping in mind that the amount of trade credit, roughly $30 billion US for India, is a much smaller proportion of its GDP than some of the other countries that we see in the infographic. Also, we see a second group of countries whose trade values are relatively the same: Saudi Arabia, China, Indonesia, Mexico. Of course, China stands out in the infographic because, given the size of its economy, the second largest in the world, it has only $20 billion US in medium and long-term trade, assuming that we can believe the data from the source we've taken these data from. This suggests that China either represents a potential boom in trade credit and a fertile field, if you will, for aspiring financial advisors looking to give trade credit, or the country represents a dead field, that there's something intrinsically wrong with these markets and that this value is low for a reason. The other way of slicing the data, of course, are to look at investment insurance. And we see that Russia performs relatively well in both areas, scoring probably the highest amongst our emerging dozen countries that we looked at in the study. And we also notice that China is the second runner-up, also having levels of investment insurance that roughly match levels of medium and long-term trade. We can cut the data in a third way, looking specifically at receivables finance in 2011. And again, China is very salient. They clearly eclipse all other countries. The next runner-ups are roughly India, Brazil, and then way at the bottom are Indonesia and Turkey. So this suggests that it's not possible to talk about shadow banking or indeed financial market development in any particular country. One has to look at the specific dimension of giving credit or taking money in order to write insurance. One has to look at the particular segment in order to assess the attractiveness of that market. And just like we've been talking about in the previous infographics, your determination about the desirability of a market will depend on if you believe that these data are low for a reason because the governments are intrinsically incompetent in their policy making, or if you believe that they are just lagging for historical or political reasons and that they will catch up. So when we look at the low values of trade insurance, receivables, and investment insurance in Mexico, an astute potential shadow banker has to determine whether Mexican policy is just naturally, intrinsically, and structurally backward and unable to develop these markets in the long run. Thus, of course, you wouldn't invest in Mexico. Or if you believe that for historical and other reasons Mexico is simply lagging behind, and as the economy slowly aligns itself with US norms, trade and investment practices, we will see a huge spurt in these values. The answer to those questions will determine your aspiring shadow banker attractiveness for investing in these particular countries. This has been another Infographic Instant with Brian Michael.